but I do believe triple-digit silver is absolutely in the cards. Hi, this is another one in the continuing series of reports from Ronnie Stufferle of Incrementum AG and the In Gold We Trust report, which is an annual report they come out with that is just amazing, the amount of research in it. And just to give you a concept of the scale of this report, the last two videos, we only got up to page 24. And now we're going to skip all the way to page 249, Silver's Silver Lining, because this is the first year that they've done an entire chapter on silver. Ronnie, how are you doing?
Very well, Mike. How are you?
Great. So I'm going to let you lead this one. I've been asking you about certain charts. Just tell me what charts are most important to you in this chapter.
Well, in general, silver, we decided to go for silver with a special chapter this year because silver is unloved, it is unwanted, it is mocked. Nobody cares about silver, like nobody cared about gold 1.5 or 2 years ago. So for a contrarian-minded investor, I think it's a fantastic time to consider exposure in silver or in silver mining companies. Now, with the help of our great colleague Emil Kalinowski, we wrote this chapter where we analyze, first of all, of course, the supply-demand picture of silver, which is different to the gold market, but then also potential drivers coming from the macro side. And then, of course, I think one of the major parts is, of course, the gold-silver ratio. Mike, that's obviously a ratio that you are showing for many years as well. And we saw in March that this gold-silver ratio, it peaked at 125. So this means with 1 ounce of silver, you could buy 125 ounces. With 1 ounce of gold, you could buy 125 ounces of silver.
Yes, and that's never happened in 5,000 years. That's never
exactly,
happened.
Exactly. Right. So we said, okay, this is, from a contrarian point of view, that's just an enormous opportunity. So we had a very close look at the silver market, and it seems that from the supply side, actually, out of 8 supply sources, 6 are basically at the stage of stagnating. So they're basically on a downward path. And I think that when it comes to the demand side, the demand that will really move the needle will be investors' demand. Now, Mike, you know that in gold, we just, we entered this party and we can see from institutional players that they're slowly entering the gold market. But institutional players, they don't care about silver yet. But I think, from a cycle point of view, at some point they will say, okay, well, we get gold, we understand it, but we want a bit more, a bit more oomph. A bit more beta, and we know that the beta of silver versus gold is roughly 3-to-1. So if gold moves 1, silver moves 3 times as much, on the upside, but also on the downside, as we saw. So I think, if you're bullish gold, then you should definitely consider silver. I think silver is also some sort of a, let's say, a sentiment indicator on gold. And we saw really maximum pessimism a couple of months ago. And now this ratio has reversed. So it basically also tells us quite a lot of about inflation dynamics. So I think the gold-silver ratio offers you a tremendous amount of information and discounts not only the economy, but also future inflation. So I think this reversal in the gold-silver ratio is quite telling.
Yeah, I'm glad though that it's still up near 100. I didn't buy as much as I would have liked to have bought when it was up at 120 and so on. But at these ratios, I will not. I read all of the news that's put on my website and all of the stuff that's happening in the world and all of the currency creation that's going on everywhere. And it just makes me want to buy gold right now. Except I just can't allow myself to do that when silver is 1/120th of the price. In these instances, I'm accumulating silver, and I plan on exchanging silver for gold at certain gold-silver ratios. As that ratio is falling, or the silver instead of the gold-silver ratio, the silver-gold ratio. As silver is rising against gold and starting to become overvalued against gold, because back in 1980, it hit 14 actually. We used to say 16, but you do a lot of research on it, and you can find different prices on different exchanges. So silver hitting that 14 to 1, well, let's say it only goes down to 20 to 1. If you're at 100 to 1, like it is right now, roughly, and you buy silver now, and you're able to exchange some of that for gold at 20 to 1, you just got 5 times more gold than you paid for. And I love that type of leverage. And personally, the reason I'm doing it is because I believe that this is something that can be counted upon. It's one of those things. You look at the long-term gold-silver ratio chart. I love these long-term historic charts. Like I said, you can take a position and count on it. And this reversion will happen in my mind. I'm not guaranteeing it for anybody else, but I'm taking action based on what I believe. And what I believe is that silver, gold is undervalued compared to all the other stuff in society, and silver is tragically undervalued compared to gold. And so it gives you that leverage. And on the way up, if at certain ratios, like at 40 to 1, I convert a little bit, 30 to 1, 20 to 1, then I'm gaining, at 50 to 1, I know it's going to 50. So if you want twice as much gold as you're paying for, you buy silver now, and when it hits 50, you convert it to gold, and you just got twice as much. If it goes to 25, you've got 4 times as much, and so on. 20 is 5 times as much. But with the gold and silver supplies that exist, the above ground stockpiles and so on, do you think there's any possibility that we could go past that 14 to 1? Do you think the gold silver ratio could hit 10 to 1 in a rush? Or even silver's value even being better than 1/10 of gold's value?
Well, I cannot rule it out, but those levels at the moment they seem pretty optimistic. But I mean, just have a look at the price now. Let's say gold at 1,700, silver at 17. If we apply the 2011 ratio at 30, silver would be worth 56 today. Yeah. That's a pretty nice performance. If we would see
saw the 1980 ratio,
yes,
that would mean
85.
Huh?
So if we would go to the 1980 ratio, which was 20, this would send silver
on a monthly chart
to 85.
Daily. If you go to a daily, you're going to find 14.
Okay.
And so you said it was, what did you say it was at 30 to 1?
30 to 1 was 56.
56. So you're talking about double that. So you're talking about 112. And I've been saying for ages that we're going to be, and that's at $1,700 gold, but we're not going to sit at $1,700 gold. $5,000 is in the cards. I think that's a slam dunk. 5,000, you got these big banks projecting 3,000 sometimes, 2,000, 3,000. Those big banks are talking about shorter term moves, and they always are very conservative, and they're always wrong. But I think 5,000 is in the cards. So if you went at 20 to 1, you're talking $250 silver, aren't you?
Yeah, I mean, we've got a big table in the report. Huh? We've got a big table in the report on page, what is it? 277, where you can see, okay, at what gold price and what gold silver ratio we will end up with which silver price. So at a gold silver ratio of 10 and a gold price of 2,400, that's $240 per ounce of silver, of course. And you know, we can run the numbers and they make me pretty confident. But what the main reason for my confidence is, first of all, I think that people underestimate the supply side. They think that all the silver is coming from silver mines, but that's not true, because silver is mostly a byproduct.
Yes,
now
60% of it's a byproduct, roughly, right? About
Exactly.
60% of supply, right? And so as the world goes into an economic slowdown, there's less copper being mined for plumbing and wiring for houses in China. There's less zinc being mined for casting for automotive. There's less lead being mined for automotive batteries. So as the world goes into this economic slowdown, which was triggered by the pandemic, but the popping, these bubbles that we're in, were destined to burst one day anyway. I think what we're going into has just been moved forward by the pandemic, but we were going to go into this later this year or sometime next year. These bubbles would have been bursting anyway, and there would be an emergency and there would be all this currency creation. The pandemic has only magnified it and moved it closer in time. You agree with all that, right?
Yeah, of course. I mean, we said we're in the everything bubble, and it's, you know, last year we already said in our report, we said the US will enter recession, because
I call it the almost everything bubble. Gold
Okay,
and silver are definitely not in a bubble compared to other assets.
That's a good point.
The only thing that you can find that's, well, some of the other commodities, you showed that long-term chart showing that commodities were historically undervalued compared to the asset classes. But yeah, it's the almost everything bubble. And this supply thing is a very key component. Now, silver being as highly volatile as it is, and what happened in 1979, you know, gold had been rising and had been outperforming silver. And then in late 79, gold had hit $400. Now, people need to remember that just 8 years earlier, 7.5 years earlier, it was 35. So 400 seemed really expensive for gold. How could it be $400 an ounce? And so some guy, you know, when it really took off, you know, it bumped its head, I think, in October and went sideways for a couple of months, and then took off like a rocket. Gold, it hit 400 and then took off to 850 in just December and January, the first half of January. But during that rush with it at $400 an ounce, a guy goes into, you know, the average income in the United States was about $9,000 a year. So a guy goes in, rushes into a bank and gets $500 out of his savings account, which was a lot of money, currency back then, a lot of currency back then. And he goes into the coin shop and says, I want to buy gold too. And the guy plops one coin in his hand and he goes, oh, is that all I can get? How much is the silver? Oh, well, you can get this many of those for the same price as one of those. And that is when the ratio takes off. You know, years and years ago, I think it was 2006 or something, I interviewed Jeff Christian of CPM Group, because I believed that the Hunt brothers were not responsible for driving, you know, people I'd say, gold hit $50 in 1980 and people, oh yeah, that was the Hunt brothers just trying to corner the market on gold and they drove it up. No, the Hunt brothers were actually seriously concerned about the dollar's potential demise, because we almost lost the US dollar in 1980, and a lot of people, almost nobody realizes that. And it was Paul Volcker coming in the commodities exchange, constantly changing the rules on them, trying to smash silver down. I believe that the Hunt brothers were the scapegoats, the people that were used to cap the gold price by changing the rules to liquidation orders only on silver. in January of 1980, where you could not open up a brand new commodities contract. You could only close out old ones. That's a rule that says until this rule is lifted, the price of silver can only go down. What they were trying to do was stop gold's runaway, because it was in a runaway. And in a runaway, gold can cause fiat currencies to fail. And so they had to get a handle on this. This is the reason they raised interest rates so high, was to get debt outperforming inflation once again, because inflation, all debt was losing value compared to inflation. So you weren't making gains on bonds. They were called certificates of confiscation. But with gold in a runaway, silver is a minuscule market. When I did my book, it was the trading that goes on in silver in a day compared to gold. Silver was 1/300th the size of the gold market back then. Mm-hmm. So it's much easier to manipulate the silver market than it is the gold market. And by changing the rules on silver while gold was in a runaway, and silver was also in a runaway, but it was the common man that actually caused this, him changing his preference from gold to silver, that caused the gold-silver ratio to change and silver to just skyrocket. By changing the rules to liquidation orders only, there's all these people that trade both gold and silver. When you go to the commodities exchange back then, it was what they call pits, or circles of guys screaming and doing hand signals at one another. And they're all, the silver pit is right next to the gold pit. And so don't you think that the gold traders are saying, boy, if they can do that to silver, we're next. And so it's time to sell gold, because the very next day, gold peaked and fell. As soon as they capped silver, gold peaked and fell the very next day. And so I believe that, and when I interviewed Jeff Christian from CPM Group years and years ago, more than a decade ago, I told him this, and he goes, yeah, the Hunt brothers added 50, maybe 75 cents at the most to the silver price. And so it was really the public changing their preference. And I believe that will happen again somewhere around $3,000 to $5,000 an ounce. The public is going to say, wow, gold was only $250 an ounce back in the year 2000, and it's hitting $5,000 an ounce. That seems awful expensive. Silver is still dirt cheap at $50. So I'm going to buy silver. And I really think that I do think that there's this potential that you could see even a 10-to-1 ratio with gold at 5,000. So that's $500 silver. Is it going to go there? I don't know. I don't have any idea, and I don't want to, stake my reputation and everything else on that. But I do believe triple-digit silver is absolutely in the cards, and I believe that these things are a certainty. It's those long-term charts playing out. It's the public rushing toward other stuff that's popular and forgetting about gold, and especially for silver. I mean, it's just not in anybody's memory, even though it is the most commonly used form of real money. But even when you measure it against all of the currencies, more stuff has been bought and sold throughout the centuries in silver than anything else. And so there's going to come a day where people rush back to it. Will it become a predominant currency once again? I don't know. I doubt it. But when you look at the mine supply statistics, in an economic downturn like this, all of that, that 60% that you're talking about, that supply goes away because they stop mining copper and zinc and lead. And so just when everybody wants it is when there isn't any of new stuff available. That, I think, is what's really exciting about silver. And it's going to cause a super spike in silver. And so we've got some exciting times coming. This will be great.
Yeah, I mean, as the old saying goes, the cure for low prices is low prices, and I think having a look at capex plans for large base metal producers, you can see that already before the whole crisis, they were becoming much more conservative, because nowadays with, ESG and lots of regulation and so on, it really takes a long time to actually from the point where you decide, okay, we'll open up a mine, to the first production. So this can be 10, 15, 20 years, with huge capex plans. So we already saw last year that most of the companies had to reduce their capex, and now it even got worse. So at some point, this will have a consequence on silver supply, and silver price or silver production isn't sensitive to the mine supply, because between 25 and 30% come from pure silver mines. So this will be one factor. But I think on the demand side, not only investors' demand will be crucial, it will also be technological demands becoming more important, because silver has fantastic attributes that you can use it in all sorts of different...
I just bought 50 solar panels. They contain a lot of silver.
Yes, absolutely.
That volatility, silver, if it does go to these spectacular levels, it's not going to stay there. It's more volatile. And when you're mentioning the 60% of the supply coming from as a byproduct from other metals, there's probably maybe a third of those, that 60%, maybe a third of it are mines that produce enough silver to where at these very high prices, they can become a primary silver producer instead of a copper producer, lead producer, or zinc producer. Or even gold producers. Once you get to these high levels, if the gold-silver ratio drops down to 20 or 10, at that point, it becomes profitable to take a copper mine and slap a new name on it, calling it a silver mine. So when it gets down to 20 or 10, the gold-silver ratio, it's not going to last a long time, but it's probably going to stabilize somewhere at 20, 25. I mean, you look at your long-term chart here, and your chart goes back 300 years, I think. Mm-hmm. For the first couple hundred years, it's down at 12 and 15, right? That's the gold-silver ratio.
Yes.
And so that's probably where it's destined to go, and then it may settle on 20. I believe there is 17 times more silver in the Earth's crust. Mineable supplies are about 12 to 1. And that is what sort of determined the natural gold-silver ratios back in, I'm making speculation here. When I saw that chart, I'm trying to figure out, well, what caused this? Why was it 12 to 1 for century after century before? You go back to Alexander the Great tried to peg it at 10 to 1. Because it was at I think in his area, it was 11 and a half or 13 to 1 or something like that. And it lasted for a couple of years and then fell apart because the free market overwhelmed it. Gresham's law came into play. One of the metals went out of circulation. Whichever metal is undervalued by the mandate, the government's mandate, ends up going out of circulation, and people spend the overvalued one gets hoarded, and the undervalued one gets the opposite. I'm sorry. But anyway, this is another one of those things that you can sort of count on, but you have to have patience.
Absolutely. Sorry for interrupting. Go
ahead.
The great financial analyst Axl Rose, he said, all we need is just a little patience. Yeah. So I think this is exactly right. Yeah. We need patience, and it's we saw dramatic moves in the silver market. But coming back to your point regarding Paul Volcker, we should not forget that Paul Volcker's job was to kill inflation. He was the man who stood up, and I read in an article that there were death threats, and everybody hated Paul Volcker because he raised interest rates, and the US entered a recession. We saw high unemployment, but now we are seeing exactly the opposite, because the biggest concern of central bankers is that they're below their for some reason 2% inflation target. So I think that Mr. Powell, he even makes, you know, Janet Yellen and Bernanke look like a hawk. So he's really uber dovish recently, and I think at some point they will reach that 2% inflation target, and they will be super happy when they reach it. And when it goes slightly above, they will be even more happy, and they won't say, okay, now let's reverse monetary policy, let's raise interest rates, let's reduce the balance sheet, and so on. They won't do that, and they wouldn't be able to do that.
I think it's going to be a situation where they achieve that by creating massive amounts of currency while velocity is still slowing. And so a lot of that currency won't be circulating. It'll be saved up. It'll be hoarded. And when they finally see it go above 2%, yeah, they'll be celebrating for a very short period of time. But then when velocity picks up, I mean, even if they don't, even if they reverse course and they start liquidating, or they, you know, when the Fed liquidates assets off of their balance sheet, they buy stuff, they sell stuff back to the banks, and the currency they get from the banks gets destroyed, and so the currency supply is reduced, but there will be so much currency saved up, it won't matter. They will have created so much by that point in time that we could see a hyperinflation even with a complete reversal of central bank policy around the world. And because the central bankers, these Keynesian economists, they've got their theories and their databases and graphs and charts and stuff that, and they're trying to follow these theories and implement these formulas and stuff and try and bend the free market to their will. But they forget that it is people's emotion, their emotions that guide the economy. I call it psychological. The economy runs in waves and cycles. Mm-hmm. There's also a certain logic to it, and that the logic is determined. Emotion and logic are usually two like opposing things, but in this case, you can look at emotion and the swings in emotion of the public, mm-hmm. and there is a logical thing that you can derive from that and apply those thoughts to what's happening in the markets. Go ahead.
We quote a study in our report where we discuss inflation, and it's interesting that this is actually a study coming out of, I think, the Federal Reserve San Francisco, where they analyze how people anchor their inflation expectations. And it's really interesting because it says that supermarket prices, so grocery shopping, is really, really important for people for their inflation expectations. Now, what we saw over the last couple of weeks, I think the grocery bills of everybody, they were way up. And I can tell you, we are talking about inflation and deflation and this interplay that we call monetary tectonics for many years now. And over the last couple of weeks, we had so many requests really from family offices, institutional investors, retail investors about inflation hedges. So it seems that, inflation is really becoming a concern for people. Now, I think when it comes to central bankers, I think that the main problem that they have is they completely underestimate the time lags. So I think their models are complex and they're sophisticated. They don't work, and I think the main reason is because of those time lags. And I recently, as I said at the keynote, it's my tequila shot theory, which means that you drink 1 or 2 tequila shots and you feel kind of good and in a good mood and cheered up, and then you have more and more, and the party goes wild, and then you wake up the next day with a complete hangover, and the sister of your best friend lying next to you, and you don't know what happened. So My wife hates this comparison probably, but you know, this time lag of when you inject and basically the moment when it really kicks in. This is something that central bankers just don't get. And now I think at some point when confidence comes back, yeah, when velocity rebounds, this would be the moment when central bankers are at this fork in the road, and then they would have to decide, okay, you know, we have to reverse monetary policy again. And I'm sure that they won't do it. And then, of course, we will get the inflation surprises on the upside. And then I think the big question is, will there be a central banker like Paul Volcker who will be able to turn it around again? If we compare the sheer size of debt levels, not only for government debt, but also for household debt, for corporations, for the financial system, and so on, compared to 1980, this is just a whole different ball game.
Interest rates will actually collapse the world economy, so they're not going to do that. They've only got one direction they can go, and that's basically to print the currency into a balloon.
Yeah.
They've trapped themselves into what I call it a Keynesian trap. They've painted themselves into a corner, and it's like I also, and I think maybe in my book or somewhere I talked about a Keynesian tiptoeing through a Keynesian minefield. And the mines get more and more dense as you go. And now you're at a spot where no matter what direction you turn, you're going to step on a mine.
Yeah.
There's just no way out of this this trap that they've created for the world economy. So I want to thank you so much. This series of interviews has been absolutely wonderful. It's great. This conversation was great. We weren't just going over charts. We were just talking. And I want to do another one of these sometime where we just have a good conversation, because this to me was very exciting.
Thank you very much.
Thank you. And for the audience, we'll see you all next time. Thanks a lot.
Thank you very much. Bye-bye.